You know, when you hear G20 finance ministers meeting, your eyes might just glaze over, right? It sounds super technical, maybe even a little boring. But what if I told you that a recent, quiet meeting in Cape Town just completely rewrote the rules of global finance for dozens of countries? Yeah, this one was different.
And that quote right there, it hits the nail on the head. This whole thing isn't about another temporary bailout or some short-term aid package. Nope. This is about a deep, fundamental shift in how the world deals with sovereign debt. It's about swapping out chaos for a clear set of rules. And that changes, well, pretty much everything.
So let's set the scene. February 25, 2026. While the world was looking elsewhere, these finance ministers greenlit a new framework that's going to shape how money flows around the globe for the next decade. The announcement itself was pretty low-key, but its ripple effects are going to be huge. So the big question is, why was this change so desperately needed? Well, to really get why this solution is such a big deal, we have to look at the problem it's trying to solve. And to put it bluntly, the old way of handling a country's debt crisis was a complete and total mess. It was breaking down right when countries needed it the most. And you can see the real-world damage it caused. The debt crises in places like Zambia and Ghana really just ripped the curtain back on this broken system. I mean, you had all these different lenders who just couldn't agree with each other, no consistent rules, and negotiations that would just drag on and on. All that uncertainty, it just freezes investment and absolutely punishes the economies that are already hurting.
And this comparison just lays it all out so clearly. We are moving away from this chaotic, unpredictable system where a debt problem was this huge politically toxic crisis and moving toward a process that's actually systematic. It turns a potential catastrophe into just a structured financial event, something you can plan for.
So how'd they do it? How did they pull this off? Well, the real power of the Cape Town framework is in three really specific, almost boring-sounding procedural changes that, together, build a whole new system from the ground up. Okay, I know, these might look like minor bureaucratic tweaks, but trust me, in the world of sovereign debt, procedure is power. Tying everything to IMF milestones, that creates a clock that everyone has to follow. Forcing all the lenders to show their cards, boom, you get transparency. And giving institutions like the World Bank an official seat at the table adds a whole new layer of stability. The point is, these three rules create predictability where there was once only chaos.
And this really gets us to the heart of the matter. We have new rules, we have a new process. But how does that actually translate into real money? How does it help a country that's really struggling?
It's a totally fair question, isn't it? How can just changing some meeting rules and disclosure forms actually make a difference to a nation's bottom line? Well, the answer is surprisingly direct. Check this out. This new framework is expected to shave 6 to 9 months off the typical debt restructuring process. Let that sink in. 6 to 9 months. In finance, time is literally money. That's over half a year that a country's economy is no longer frozen in uncertainty, no longer bleeding investment, and no longer just stuck in limbo. That time saved is absolutely critical for the balance sheet.
And here's where it gets even better. Markets absolutely hate uncertainty. As you can see here, when there's a high risk of a long, drawn-out, messy process, investors demand much higher interest rates to lend a country money. But the moment you introduce certainty into the process, that risk premium drops. And what's the result? A lower cost of capital. It becomes cheaper for that country to borrow and to invest in its own future. See, markets don't reward need, they reward predictability.
You know, another huge win here was getting everyone on the same page. For years, trying to get the traditional lenders, that group of countries called the Paris Club, to agree with newer big lenders like China, plus all the private hedge funds, it was next to impossible. This new framework creates a common playbook for all of them, which cuts down on all the friction and game playing that used to grind everything to a halt.
But this new system isn't just a safety net for countries that are already in trouble. And this is a really key point. It's actually a strategic tool. It's a massive opportunity for proactive, reform-minded governments who are willing to seize it.
So here's the bottom line. The new framework is not a blank check. It rewards countries that get their financial house in order before a crisis ever hits. By doing things like improving tax collection or cutting wasteful spending, a country builds up massive credibility. It means they can walk into any negotiation not from a position of weakness, but from a position of strength. The new rules actually become their leverage.
So let's pull all these threads together. What is the single biggest takeaway from this whole new global framework? It's that the very definition of what makes a country a safe bet for investors has just fundamentally changed. For decades, the main way we judged a country's financial health was by looking at its debt-to-GDP ratio. And that's still important for sure. But the new, absolutely critical variable is process certainty. How predictable is the system if things go south? That is now the defining question for global investors.
And that leaves us with a really fascinating question for the future, doesn't it? In this new game, where the rules reward predictability and proactive reform, well, it's not about who needs the money the most anymore. It's about who understands the new game. So, which countries are going to master these rules first and become the new magnets for capital? That's the story we should all be watching.